everyone, welcome to EduTap and welcome to today's Finance 360-degree session. This is one of the most important sessions that I have brought for you, and in this session we are going to discuss the Monetary Policy Committee meeting that was held in February 2025. Now, why this MPC meeting is so important? Because after nearly 5 years, there is the decision that has been taken by the MPC to reduce the repo rate. So, the last decision of reducing the repo rate was in May 2020, and now the MPC has decided to reduce the repo rate. Why this decision has been taken at this point of time? What explanation has been given by the Monetary Policy Committee, by the Governor of the RBI and the Chairman of the MPC, as well as what are the projections that have been shown for the CPI inflation, for the real GDP, what is the statement that has been provided by the Governor of the Reserve Bank of India and the Chairman of the MPC regarding the depreciation of the rupee that has been continuously happening. What is the current scenario of the economy? All of this we are going to discuss in today's session, and let me tell you that in the previous years in the RBI Grade B examination, we have seen that the timeline is being asked that since when the repo rate has been increasing, or since when the repo rate has been at 6.5% and such. So you can understand that now this becomes a very hot topic. This becomes a very important topic for your question to be framed in the examination, okay? That the MPC, after nearly 5 years, what was the requirement for decreasing the repo rate and all. So this we are going to discuss in today's session, and a lot of things you are going to get to know in this session, and this is going to be very important. So good morning everyone, welcome to the session, and let's get started with today's session without any delay. So first of all, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is provided in the description box below. Do give me a thumbs up if I am clearly audible and visible, so that there is no discrepancy in the voice, okay? So do give me a thumbs up. So we are starting with the Monetary Policy Committee meeting that was held in February 2025. Now, Monetary Policy Committee has 6 members, and the chairman of the Monetary Policy Committee is the Governor of the Reserve Bank of India. That I hope you all know that there are 6 members in the Monetary Policy Committee, and the head or the chairman of the Monetary Policy Committee is the Governor of RBI. That is currently Sanjay Malhotra. So now, first of all, MPC held its 53rd meeting from February 5th to 7th, 2025 under the chairmanship of Shri Sanjay Malhotra, the new Governor of the Reserve Bank of India. The MPC members, Dr. Nagesh Kumar, Shri Saugata Bhattacharya, Professor Ram Singh, Dr. Rajiv Ranjan and Shri M. Rajeshwar Rao attended the meeting. Okay, so all the members were present in the meeting, that you can understand, and the unanimous decision has been taken. Whatever decision has been taken in the Monetary Policy Committee meeting, this decision is unanimous. Okay, so you can understand that all the members agreed with the decision. So after assessing the current and evolving macroeconomic situation, the situation of whole of the country, the MPC, the Monetary Policy Committee, consisting of 6 members, unanimously decided to reduce the repo rate by 25 basis point, that is by 0.25%. So repo rate has been decreased from 6.5% to 6.25%. So repo rate has been decreased by 25 basis point, that is by 0.25%. Okay. Now why this decision has been taken? First of all, what will be the impact of this decision? So here you can understand that first of all, repo rate is the rate at which the banks take the loan from the Reserve Bank of India against the collateral that the banks have to provide in the form of government securities. Okay. Now, if repo rate has been decreased, that means banks will be able to take the loans from RBI at cheaper rate, at lesser rate. So, if banks are getting lesser rate banks are taking the loans at the lesser rate from the RBI, so banks will want to take more loans from the RBI at the lesser rate, and if banks are going to have more money, they will supply more money in the economy, they will provide more loans to the customers, so money supply will increase in the economy, the demand will increase. With the increasing demand, the production will increase. Okay, so banks will start getting the loans at lesser rate from the Reserve Bank of India, and the banks will also start providing the loans to its customers at the lesser rate. So the cost of loans is going to reduce for the customers also. So this is the idea, that the banks will get more loans, or the banks will want to take more loans at the lesser repo rate. So the banks will have more money supply, and they will supply more money to their customers, due to which the demand will increase, due to which with the increasing demand, the productive activities will increase in the economy, and the customers will also get the loans at the cheaper rate because the repo rate is decreasing. Any confusion here? So this is the idea. So to boost the economic activities in the economy, the RBI has decided to, or the Monetary Policy Committee has decided to reduce the repo rate in the economy by 25 basis point. Now the repo rate is a part of liquidity adjustment facility. The repo rate is a part of liquidity adjustment facility. Okay, in the middle of the liquidity adjustment facility corridor, there is repo rate. The lower end of the liquidity adjustment facility is the standing deposit facility rate, and at the top there is MSF rate. Okay, so the SDF rate is lesser than the repo rate by 0.25%. The MSF is higher than the repo rate by 0.25%. So if repo rate is 6.25%, the SDF will be 6.00%, that is 6%, and the MSF will be 6.50%. So basically, this is the liquidity adjustment facility corridor. Through the deposit facility, the RBI can take the deposit from the banks. Through the repo rate, or at the repo rate, the RBI can lend to the banks, and through the MSF, through the Martian Standing Facility, the RBI can lend to the banks at the higher penal rate of interest when they have utilized the whole of the limit of repo rate. So if the bank has taken the complete loan under the repo rate within the limit of the repo rate or repo operation, so after that the banks can take loan under the MSF at the higher rate. Okay, so this is the liquidity adjustment facility corridor. The deposit rate of the RBI, the lending rate of the RBI, the penal lending rate of the RBI. If the banks have already utilized the repo rate, then they take the loan at the MSF rate. Okay, so this is the idea. So here you can see that the SDF rate has been adjusted to 6% and MSF rate has been adjusted to 6.5%. So MPC unanimously also decided to continue with the neutral monetary policy stance. So now if the monetary policy has already decreased, if the Monetary Policy Committee has already decreased the repo rate, why the Monetary Policy Committee is sticking with the neutral monetary policy stance? So let's understand that why this decision has been taken, why the repo rate has been decreased, why the decision has been taken to maintain the neutral monetary policy stance. So first of all, the MPC noted that inflation has declined in the recent months. So I will show you the data. So in November and December, the inflation has declined from the previous month, from the October high. So in October, the inflation was quite high. It was breaching the 6% mark. So after the October, in November and December, the inflation gone down. Okay, so in October, the inflation was above the 6% mark. But in November, December, the inflation was below 6% mark, and in January also, it is expected that the inflation will continue to fall. So the MPC noted that the inflation has declined, supported by a favorable. Now there is a support from the favorable outlook on food inflation, that the food prices are going to go down or the food prices are going to be controlled. Continuing transmission of past monetary policy actions. So it has been said that in the past monetary policy, so in the past, the repo rate has been kept high. So if the repo rate has been kept high, that means the demand was controlled in the economy and the prices. So if demand is less, the prices will reduce. So to control the inflation, the Monetary Policy Committee has kept the repo rate high to control the inflation in the economy, and that effect is being shown now, because it's not like now that today the RBI or Monetary Policy Committee has decided to reduce the repo rate so today the money supply will increase, today the whole transmission will happen. No, it takes time. So the Monetary Policy Committee is saying that the previous monetary policy decisions that were taken to keep the repo rate high at the 6.5%, that effects are going to be shown now, and the continuing transmission is happening of the previous monetary policy decisions of keeping the repo rate at the higher percentage. So now the MPC has the leverage, has the position to reduce the repo rate now for the further months. Okay. So there is continuing transmission of the past monetary policy actions. It is expected to further, the inflation is expected to further moderate in 2025-26. So it is expected that the food prices are going to decrease, or the food inflation is going to get controlled, and with the continuing transmission of the previous monetary policy, there is the expectation that the inflation is going to go further down in 2025-26, gradually aligning with the target. So the target of inflation is, the inflation target is 4%. The inflation target is 4%, and it is expected that in 2025-26 we are going to meet this target, or we are going to be near to this target. Now the range is plus minus 2%, that is inflation should not go below 2%. Inflation should not go above 6%. But in October, the inflation, the headline inflation, the retail inflation was above 6%. But now the inflation is slowly declining. In November, it has declined and came down to from 6% mark. In December also, December 2024, also the inflation came down. In January 2025 also, it is expected that the inflation will further reduce. And in 2025-26 financial year also, it is expected that inflation is going to decrease and come to this target that we have decided at 4%. Okay. So you can understand that for the inflation, there is positive expectations that, okay, inflation is going to go down. But when we come to growth, now growth has become a problem in the country. So MPC noted that though growth is expected to recover from the low of Q2 2024-25. So in the Q2 of 2024-25, the growth was low at 5.4%. Why we are saying that 5.4% is low? Because if we compare 5.4% to 8.1% of the same quarter in the last year, so you can understand that how much there is difference. There is huge difference. Okay. So the 5.4% of the India's GDP growth in the Q2 of 2024-25, this was 7-quarter low. This was 7-quarter low. And it is also a big trouble because you can understand that the real GDP, it was expected at 5.4% in Q2 of financial year 2024-25. This is very much lower as compared to the same quarter of the previous financial year, where the growth of the real GDP was 8.1%. So from the 8.1% of the real GDP growth in the same quarter in the previous year, we have come down to 5.4% of the real GDP growth in the same quarter in the current financial year. So this is a big trouble. So here the MPC has noted that though the recovery is expected in the growth rate, but still the growth rate is very much lower as compared to the last year same quarter. So the MPC has said that, okay, the inflation is declining. Now try to think about it. What will you do? That if inflation is declining, and it is expected that the inflation is going to further and further decline in our country, and with this inflation declining, growth is also becoming a problem. So inflation is declining in our country, that is good news, but the growth is declining, so that is the problem. So in this case, the RBI now is saying that seeing this inflation and growth projections, and seeing this inflation and growth dynamics, open up policy space. So seeing this growth and inflation dynamics, now the policy space has been opened up for the MPC to support growth. Now the MPC is not so much worried about the inflation, because inflation projection is going downwards. Inflation is going downwards. So MPC, Monetary Policy Committee, is not worried about inflation. So now the MPC can focus on growth. Okay. So for growth, MPC has reduced the repo rate. With reduction in repo rate, there is more loans that the banks can take at the lesser repo rate. The banks will be taking more loans at the cheaper rate. So banks will be providing loans at the cheaper interest rate. So more loans will be taken by the customers. More loans taken by the customers means more demand by the customers. And with more demand, there will be more productive activities, more production. More production means more growth in the economy. So that's why this decision has been taken to reduce the repo rate now, seeing the growth situation in the Q2 and seeing the declining inflation. Okay. So these growth inflation dynamic open up policy space for the MPC to support growth while remaining focused on aligning inflation with the target. So accordingly, the MPC decided unanimously to reduce the repo rate to boost the growth in the country. Why neutral monetary policy stance then? Till now, any confusion, anyone? Till now, any confusion? Anyone has? So why the neutral monetary policy stance? So the RBI is saying that, okay, the inflation projections, the inflation expectations are lower, that, okay, inflation is going to go down. But at the same time, there is excessive volatility in the global financial markets and continued uncertainties about the global trade policies, and coupled with adverse weather events that can happen and that can affect the food grain production. So right now our expectations is good that, okay, the inflation is going to go down in the coming months, in the coming financial year. But what if there are some adverse weather events? What if there is some global trade policies that is changed? So there is some adverse conditions that can happen which can affect the growth and inflation outlook that we currently have. So this calls for the MPC to remain watchful, and MPC has said that we are going to follow the neutral monetary policy stance. That means in the coming Monetary Policy Committee meeting, we can increase the repo rate if required, we can decrease the repo rate if required as per the condition of the inflation and growth in the coming months. Okay, so neutral monetary policy stance means that it is providing a neutral position to the Monetary Policy Committee to increase the repo rate or to decrease the repo rate. There is no pressure on MPC to take a certain action. Okay, so this calls for MPC to remain watchful because there are some uncertainties. So accordingly, the MPC has decided unanimously to follow the neutral monetary policy stance that provides the flexibility to the Monetary Policy Committee to respond to the changing macroeconomic environment, and MPC can increase the repo rate or decrease the repo rate in the coming months, or can keep the repo rate same also. Now, why this decision is so important that, okay, repo rate has been decreased. So what? Why this is so important? Because the last repo rate cut happened in May 2020. So it is nearly 5 years that after nearly 5 years the decision has been taken to reduce the repo rate. Because since 2020, you can understand that since May 2020, so in May 2020, the repo rate was decreased by 0.40%, that is by 40 basis point. The repo rate was decreased and repo rate became 4%. So repo rate was decreased in May 2020 from 4.40% to 4%. So repo rate was decreased in the May 2020 from 4.40% to 4%. From then onwards, the repo rate was at 4% till, you can understand, 2022. But in May 2022, there was decision that was taken that we will start increasing the repo rate. Okay, so from May 2020 to May 2020 to 2022, there was same 4% of the repo rate that was taken. But in May 2022, there was the increase in the repo rate that happened, and since then there was continuous increase in the repo rate that was happening. Okay, so in May 2020, the repo rate was decreased from 4.40% to 4%. Now in May 2022, the repo rate was increased from 4%. Here you can see that in May 2022, the repo rate was increased from 4% back to the increase in the policy repo rate by 40 basis points, so back to 4.4%. Okay. So in May 2020, the repo rate was decreased from 4.40% to 4%. In May 2022, the repo rate was increased from 4% to 4.4%. Okay. So from May 2022 onwards, there was continuous increase in the repo rate that was happening, and the last increase in the repo rate was in February 2023. So in February 2023, the repo rate was increased to 6.50%. So you can see that till February 2025, till February 2023, there was increase in the repo rate. After that, from February 22, from later on onwards, the repo rate was kept at 6.50%. So now the repo rate has been decreased. So this is the whole system I have shown you, that in May 2020, the repo rate was decreased from 4.4% to 4%. In May 2022, the repo rate was increased from 4% to 4.4%, and from May 2022 onwards, there was increase in repo rate that was happening continuously. Okay, and in February 2023, the last repo rate increased happened and the repo rate was increased to 6.5%. After that, from April onwards, from April 2023 onwards, the repo rate was kept constant at 6.5%. Okay, from April 2023 onwards, repo rate was kept at 6.5%. Now in Feb 2025, the repo rate has been decreased from 6.5 to 6.25%. So write it down in a very nice, neat manner so that you have the timeline, because from the timelines in the previous years we have seen the questions directly in the 2023, also in the 2024 examination also we have seen the questions from the timeline of the changes in repo rate. Okay, so that's why I have brought this whole complete timeline. See, liquidity adjustment facility, this is a static concept. Basically in the liquidity adjustment facility there is SDF, there is repo rate and MSF rate. Okay, if you don't know about these rates, you have to go through the static. SDF rate is the deposit rate of the RBI, that is lesser than repo rate by 0.25%. MSF is higher than the repo rate by 0.25%. So if repo rate is 6.25%, SDF will be 6% and MSF will be 6.5%. So this is the liquidity adjustment facility, the corridor. Okay. Now coming to the next point, now coming to the projections, domestic economy, real GDP. So as per the first advance estimates released by the National Statistical Office, real GDP is estimated to grow at 6.4% in 2024-25. So this is the first advance estimates released by the National Statistical Organization. So the real GDP is estimated to grow at 6.4% in 2024-25. Remember that second advance estimates as well as the final estimates will also be released in the later on period. Okay. Supported. Now, why the growth has been seen in our country? This was supported by private consumption of the consumers. On the supply side, there is growth in the services sector and a recovery that happened in the agriculture sector, while the industrial growth was having a drag, was not very encouraging. Okay. Looking ahead, healthy Rabi prospects. So the winter crop prospects are very good, that are going to be harvested in March-April months. So there are healthy Rabi prospects and an expected recovery in the industrial activity is also expected. This should support economic growth in 2025-26. So healthy Rabi prospects, healthy Rabi harvesting and the expected recovery in the industrial growth, this is expected to lead the economic growth in the 2025-26. Among the key drivers on the demand side, household consumption is expected to increase because of the tax relief being provided to the people under the Union Budget of 2025-26, as the limit of the income has been increased for the rebate. Okay. Next is fixed investment is expected to recover. Fixed investment in the factories, in the farms, in the businesses, it is expected to recover. So fixed investment in the machinery, tools, equipments, factories. So the fixed investment is expected to recover, supported by higher capacity utilization level. That means the factories, the firms, they are utilizing the higher capacity in their farms. They are utilizing the machinery nearly to the fullest of levels. That means their production is quite high right now and they are utilizing the machinery to their fullest capacity. So that means they will require the new machineries now, because the older machineries are working to the full already. So higher capacity utilization levels are there. That means new machineries, new tools, new equipments, new factories will be required to further increase the production. Healthy balance sheet is there in the financial institutions, so they will also invest in the bonds, in the shares and such. So that will also further boost the private investment, and the fixed investment will also be boosted, because if the financial institutions are investing, they are providing the money to the businesses also, okay, to further expand their production. And corporates. Government continued emphasis on capital expenditure. So government is spending on schools, hospitals, road, tunnels, bridges and such. So government is also spending on the fixed investment, and resilience is coming in the service export. This will continue to support the growth. However, there are problems from the geopolitical scenario, from the geopolitical tension. Protectionist trade policies, trade tariff or the tariff regime has been started by US, China. Both are imposing heavy tariffs on each other. So that is creating problem at the geopolitical level, at the global level, because US and China are two big countries, if they start a trade war, that will involve many of the other countries also. So there is protectionist trade policies that are being adopted. Volatility is coming in the international commodity prices, financial market uncertainties are there. This continue to pose downside risk to the outlook. So if we see the production and consumption side, they are doing good in our country, but there is problem that is coming from outside, or there is problem that can come from outside. So taking all these factors into consideration, it is said by the Monetary Policy Committee that the GDP growth for 2025-26 is projected at 6.7%. So first advanced estimate of the NSO is saying that the 2024-25 real GDP growth is expected at 6.4%. For 2025-26, MPC, Monetary Policy Committee, has said that the real GDP growth is expected at 6.7%. Okay? Any confusion till now, anyone? Any confusion? Now we are coming to inflation. Clear? What about the others? It is clear to Sorish. What about others? Clear, Nitya? Okay. So domestic economy inflation. See, here you can see that in October 2024, the CPI is the consumer price index. That is the consumer price index combined for the whole of the country. So CPI inflation is also known as retail inflation or the headline inflation that affects the consumers in the country. CFPI, this is the consumer food price inflation. Consumer food price inflation is your CFPI. Okay. So here we are seeing through the red line, we are seeing the food inflation. Through the blue line, we are seeing the retail inflation and the inflation in the country for the consumers. So you can understand that in October 2024, the food price inflation was very high, and due to which the CPI inflation, the retail inflation, was also very high. It was, see, the inflation target is 4%, the range is plus minus 2%. So 2% and 6%. So inflation should not be above 6%. But in October 2024, the inflation was above 6%. So that was a problematic situation. But in November, it is seen that the inflation has come down to 5.48%. And in December, the inflation has further come down to 5.22%. And in January 2025, it is expected that inflation is further going to come down from the 5.22%. So you can understand that the inflation, the CPI retail headline inflation, is declining in the previous months. That's why the RBI or the Monetary Policy Committee said that the inflation has lower projections. Okay. And the food inflation is also coming down. So that is good news for our country. So headline inflation has softened. It has come down sequentially in November and December 2024 from its peak in October 2024. The moderation in food inflation, the moderation has come in food inflation. Food inflation has also declined as vegetable price inflation came off from its October high. So in the October, the food inflation was also very high, and the vegetable inflation specifically was very high. The vegetable prices were very high. So food inflation has declined, the vegetable prices have being controlled. So food inflation coming lower, food inflation becoming lower has led to retail inflation being lower. Okay. Core inflation means the CPI inflation excluding food and fuel prices. So excluding the volatile prices. So core inflation remained decreased or subdued across goods and services component, and the fuel group or the fuel and power, we can say, they have continued to be in deflation. That means their prices are actually declining. So the food inflation is declining because of the declining inflation in the vegetable prices. So food inflation is declining, that you can see. With the food inflation declining, the CPI inflation is also declining, and the fuel group, in the fuel group actually deflation has come. That means prices have started to decline. Okay. And the core inflation is also subdued, it's also at a lower level. So core inflation means the inflation, the CPI inflation excluding food and fuel prices. Going ahead, food inflation pressures should see a significant softening. That means food inflation pressure, it is expected that they are going to further lower. So that is going to be very good news, and due to which the MPC is saying that the inflation is going to decrease in our country and will come to the 4% of the target level and around 4%. So it is expected that the food inflation pressures should see a significant softening due to good Kharif production that is going to happen in the summer season, winter easing in vegetable prices, and favorable Rabi crop prospects. Rabi crop will be harvested in March and April month. Okay, so good Kharif crop and good Rabi crop prospects. So due to this, it is said that the food inflation pressures are going to go down, due to which inflation is going to go down from 5.22% to around 4%. And remember this, that there can be some supply side shock that can happen. If the supply side shock happens, then there will be problem, because let's say something happens, some disaster happens, then there will be problem. Otherwise, the prospects are very good. The core inflation, that is CPI inflation excluding food and fuel prices, is expected to rise but remain moderate. So continued uncertainty in the global financial markets coupled with volatility in the energy prices and the fuel prices and such, an adverse weather event, they are some risk that can come in our prospects. Okay, so there are some risk, adverse weather events, the volatility in energy prices, the global financial market changes that are happening. So they are some risk, and these risks can affect the inflation outlook in our country. Okay, so this is the idea. So taking all these factors into consideration, the CPI inflation, the consumer price index inflation for 2024-25 is projected at 4.8%. Assuming a normal monsoon, next year the CPI inflation for the next financial year 2025-26 is projected at 4.2%. That is quite lower, and that is very much near to our target of 4%. So you can understand that for the next financial year, the prospects are very, very good. Okay, so these are the highlights that we have discussed. The external sector is the last point that we have to discuss, but in the highlights we have discussed about the rate cut in the repo rate from 6.5% to 6.25%. GDP expected to grow at 6.7% in 2025-26. Inflation projected at 4.2% in 2025-26. Global risks are there that are posing some problem in our country, or that can pose problem in our country. Neutral stance has been maintained to allow flexibility to the MPC. Other adjustments have been done. SDF with the repo rate, SDF and the MSF have also been adjusted. Okay, so these are some of the highlights that you can see, and these highlights I have provided you so that you have the idea. Now external sector. So okay. So external sector. So first of all, how many of you know that currently there is huge depreciation that is happening of rupees against dollars? So rupee value is decreasing. Depreciation is happening of the rupee value against dollars. The rupee is depreciating against dollars. We have to give more and more rupees to get $1. That means rupee is getting weaker. So how many of you know that rupee is getting weaker or rupee is depreciating in the previous few months or previous few days? So what is happening that the Monetary Policy Committee and the governor, so in the governor statement that was given after the Monetary Policy Committee meeting ended, so governor of the RBI stated that because of the reduced expectation of the rate cuts in the US, so that means the rate cuts are not expected in US. That means rate is going to be high, the interest will be high in US. Because of that, if interest is high in US, that means bond yields have hardened. They have increased in US. The bond yield have hardened in US. That means many of the investors will want to invest in US because there the bond yield is high. The returns of bonds is very high in US. So many of the investors, they want to invest in US. So they are taking out the money from the emerging market economies, from India and such economies. The money is being taken out from the foreign investors, and this money is invested in US because the bond yield is increasing or has increased in US. So the US dollar has strengthened and the bond yield has hardened. Okay. emerging market economies have witnessed large capital outflows because from the emerging market economies, the money is being taken out by the foreign investors and this money is getting invested in US because of their bond returns being high. So this has caused, because of the large capital outflows from the emerging market economies, this led to sharp depreciation of the currencies in the emerging market economies like India. So Indian economy, though continuing to remain strong and resilient, but we also faced the brunt of depreciation of weakening of our currency against the dollars, and due to this the rupee is depreciating against dollars because of the external scenarios, because of the global headwinds. Our currency is also depreciating against the dollars because in US the bond yields have hardened and many of the foreign investors want to invest in the bonds of US. So they are taking out money from our country. The foreign investors, they are taking out the money from our country and investing it in US. Okay. So this has caused depreciation of rupees. Now the RBI has said that RBI has been employing various tools to manage the value of our rupees. Okay. So multi-pronged challenges are being faced by the country and the rupee, but still the RBI is trying different tools to manage the value of rupees. Now according to the World Bank, India with an estimated inflow of 129.1 billion US dollars continues to remain the largest recipient of remittances globally. So from the global level, from the other countries, we are receiving the highest of the remittances or largest of the remittance we are receiving from the other countries globally in 2024. The current account deficit. So current account of our country includes the trade in goods, the trade in services and the transfer payments, the remittances and such that come from the other countries or that goes to the other countries. So current account, this is the current account. So current account deficit, it is said that the current account will be in deficit, especially the trade in goods will be in deficit as we will import more. So there is going to be the deficit in the current account, but this will be in the sustainable level. So that is not a very big problem. As on 31st January this year, India's foreign exchange reserves stood at 630.6 billion US dollars, providing an import cover of over 10 months. And overall, India's external sector has remained resilient. Okay, so this is the idea about the external sector. I hope this is very much clear. Any confusion, anyone? Now, this was regarding the Monetary Policy Committee meeting, as well as the governor of the RBI has also stated about the external sector. Now, there was a slight mistake that I did in the previous session. So, see, the RBI has announced the Standing External Advisory Committee. Okay, this was announced in 2021 and then the Srimati Shamla Gopinath was chosen as the chairman. Now the Standing External Advisory Committee has been reformulated in 2025. Okay, in 2025, and the new chairman is Shri M.K. Jain. So the previous, I wanted to show you the previous and the new one, but by mistake I only brought the previous one. Okay, so the previous chairman was Shri Shamla Gopinath. The new chairman is Shri M.K. Jain. So in January 2025, the SEAC committee has the chairman Shri M.K. Jain. So RBI announced the names of the members of the Standing External Advisory Committee that was formulated in 2025 for the period of 3 years for evaluating the application of Universal Bank and Small Finance Bank, and the chairman of this committee for the new committee, the chairman is Shri M.K. Jain. For the previous committee, the chairman was Srimati Shamla Gopinath. Okay, any confusion, anyone? So now there is a question regarding MSF. I will explain you that, but before that, let us see the questions. Okay. So before that, let me show you that this is the website of EduTap. If you go to edutap.in, you can go to this website of EduTap where you can get the free material in the blog section. So in the blog section, you can get the free material about the exam. Whichever exam you are preparing for, let's say RBI Grade B exam you are preparing for. So regarding the RBI Grade B, you can get the exam information. You can also get the strategy for the examination. You can also get the success stories in the written form. So these are the blogs that are freely available for you to understand about the exam, for you to get the strategy, for you to get the success stories, okay? So that you can understand the strategy that the toppers adopted. So this is in the written form, okay? As well as if you go to the final session, or if you go to the final page, you can go to the courses section and you can see the RBI Grade B courses, what all is provided at what price, what off you are getting and everything you can see here. Now this is the first question. I hope you will be easily able to answer this question. So this is the first question that I hope you will be able to answer. Okay. And this is the second question. Again, a easy question. You have to remember the projections. Okay. Now, Bhavna was asking me about MSF. So see, at repo rate, the banks can take loan from the RBI. The banks can take loan from the RBI at the repo rate, and the banks have to provide the collateral to the RBI. Now, there is the limit under repo rate or under the repo operation, how much loan the banks can take from the RBI. There is some limit because RBI also does not have unlimited money now to keep on giving as loan. So then there is the MSF, that if the banks have already used the limit under the repo operation and the bank is in the liquidity crunch, the bank requires the money immediately. So the bank can take the extra money from the RBI. The bank can take extra loan from the RBI under the marginal standing facility, which has a penal rate. That is why the MSF rate is higher than the repo rate by 0.25%. Okay, so MSF rate is higher than the repo rate by 0.25%, and the MSF facility is used when the repo rate limit you have already used. Okay, and do tell me in the comment section the homework questions, and whatever confusion you have, you can also share in the comment section. So this is it. See, Bhavna, you have IBPS PO interview. So I will suggest you that we have EduTap has the banking channel also. So there you can ask the faculties that what are the important topics. Okay. Thank you so much. Sorry, thank you so much, Vishwajit. Do tell me in the comment section what are the answers of the homework question, and do tell me if you like the session, as well as do like there is a shorts that I have made about the MPC. Do see that, do like that, because such shorts will give you the information in the faster manner and in the short span of time. So do see that shorts and do answer me the question that I've asked there also, so that I know that you know about the SDF and MSF. Okay. So do see the shorts that I have released regarding the MPC also, and do comment there also that what is the SDF MSF, so that I know that you have heard this session and you know about the SDF and MSF now, the new percentages. Okay. So thank you everyone. Thank you for joining. Do answer me the homework questions in today's session in the comment section, as well as do see the shorts and do give the right answer of the SDF and MSF in the shorts. Okay. Descriptive topic, it can be MPC itself, it can be on the master directions that the RBI has recently released, it can be about the external situation or external sector about RBI. Okay, Akshit, you can write a mail at hello. Akshit, you can write a mail at hello@edutap.co.in in regards to your query, so that the team can see it and answer. Yes, this will be enough for the current part. Okay, so this is it. Thank you everyone. Thank you very much for joining the session. Do see the shorts also. To comment down below in the shorts that